Good morning, Hayden, and welcome to What's Up Wednesday, the first of 2022. Looking forward to an exciting year, and we've opened up to quite an exciting chapter in our lives. I was chatting earlier, just mentioning that if you're suffering from constipation, the best thing to do is to look at your share portfolio. It will release quite a bit of the congestion inside your body. So maybe if you could talk to us a little bit about where we are with the markets at the moment and this massive price correction.
Yeah. Morning, Gary. Thanks for chatting. I think this is our first one of 2022. So safe to say the year has got off to an interesting stroke volatile start in the equity space. And then we'll have a look at the rand in a little bit more detail as we carry on the chat. But yeah, 2021, as it followed on from 2020, was a banner year for stocks. There just seemed to be no potholes in sight. And I'm talking specifically about the offshore market, because at Foundation Fund Managers, we focus on offshore share portfolios. The US market, for example, suffered its last 10% correction on the S&P 500 in October 2020. That's a long time ago in the stock market. Yeah. And I think people got used to just returns after returns, month after month. And there was a lot of good reasons for those gains, primarily accommodative policy, monetary policy from your central banks.
Absolutely.
That tide has turned, and the central banks and the Fed especially is looking to tighten the taps, and the market got well and truly spooked in the first week of January, right through to Monday this week. So it's been a 3-week plus sell-off. And an aggressive sell-off at that. The NASDAQ index is, I think, probably 15+% down. Individual stocks in that a lot worse than that. The S&P went past 10% a day or two ago. So yeah, if you are invested in the market, don't worry, but don't look at your portfolio.
Absolutely. But I mean, at the same time, what a massive buying opportunity. Tech stocks have dropped significantly. You were chatting about Apple and their earnings and good quality tech stocks. So perhaps if you can just allude a little bit on that.
Yeah, for sure. So, very, very briefly, what the market's got concerned about is rising interest rates in the States, which diminishes the future value of your returns, because some companies that are highly leveraged now have to pay a lot more back in terms of their debt repayments. It squeezes their margins, they become less profitable, the share price falls over. Unfortunately, the tech sector gets lumped all into the same basket, okay? But in that basket, you've got two very distinct camps. You've got your high quality, well-established, been around for a long time, mega cap technology stocks that have a very, very proven route to market, good revenue streams, wide margins. They make a lot of money. Your Apples, your Microsofts, your Amazons, your Googles, your Facebooks, all of these guys sit in that camp. And Microsoft is a perfect example of that. They, last week, put their hand in their back pocket and pulled out a check for $70 billion in cash to buy a gaming company, Activision Blizzard. Activision Blizzard's share price had come down quite a bit because of the tech sell-off recently, and they saw it as an opportunity to bring a gaming component into the Microsoft stable and give them access to this whole new metaverse world that we're apparently going to live in a couple of years' time. $70 billion in cash. It was less than 50% of their total cash pile, but it's a staggering amount of money. Apple has got even more money.
So these tech stocks that we hold, I mean, they've got money. It's the smaller, I would say the smaller tech stocks are the ones that are going to be experiencing the most volatility and losses, and potentially not getting back into the market again.
You're exactly right.
Yeah.
Those newer guys, companies that have recently come to market, IPO'd as it's named, initial public offering, they've got a fantastic idea and they're going to change the world and they're selling the story, but they're up to their eyeballs in debt because they're still in massive R&D and fundraising rounds, trying to even get to listing status. And they've, by and large, haven't got a massive revenue stream. They are trading on future earnings, not current or previous earnings. And now all of a sudden, interest rates are going up. It's going to be more difficult for them to repay the money that they own. They don't actually have a revenue stream to speak of. And investors get really spooked about those types of stocks and they get bombed. An example of that is Peloton. Peloton is an exercise bike or exercise equipment maker. They really, really shot to the top of the pops during COVID. Everybody had to live at home 24/7, couldn't go to the gym, couldn't exercise. Peloton had these bikes that you put in your lounge or wherever. It's got a big color screen on it, and you beam a workout into your bike, and it tells you what to do, and you have your gym workout at home. Great idea during COVID. They sold hundreds and thousands of bikes, and they did very well. Those bikes are now collecting dust, and everybody's back at the gym. And in fact, last week, Peloton, there was a leaked report confirming that they've halted production of bikes. They're not making any more bikes. They've got so many in stock, they can't sell them. And their share has fallen off a cliff. Netflix is similar, subscribers are falling, people are not having to sit and watch TV all day. So those types of stocks at Foundation Fund Managers, we don't own them. We didn't want to have the COVID play in our portfolios. We wanted the longer term play. And for our clients out there, rest assured that while their stocks are selling off, they're going to recover because they're established.
So basically what you're saying is if I've got spare cash, I must buy some good quality tech stocks now through you. And if I want a bicycle, I must wait a bit longer until the Peloton bikes are really, really discounted. And I can get a fantastic bike for a good deal too.
Absolutely. But Gary, you slim and trim. You don't need an exercise bike.
Let's get on to the rand. So 2022 has been well underway. We're almost at the end of January. Life's not been boring for the rand, as we all know. How have we traded over January so far?
For sure. So it's, never dull for the rand, and has been a bit of a wild ride so far. In January, it's 3 and a bit weeks. Our worst level, which luckily was in the first week of January, so it's in the rearview mirror now, up at 16.07 to the dollar. And our best level, which was, I think, Thursday last week, 15.07 to the dollar. So pretty much a rand trading range there. If you look at the chart, there's a definite strengthening trend. We always go up and down, but there's a strengthening trend in place. We're trying to get to 15 flats and into the 14s. As I say, 15.07 is the best so far, and let's see if we can get there.
Yeah. So, I mean, there's 3 main driving forces that are affecting the rand. One being the Fed, where they're going to be talking about their interest rate hikes, the Reserve Bank tensions, and also the looming or potential war with Ukraine. I mean, what's going on there?
Yeah, that's a concern. I mean, that's a geopolitical issue, nothing to do with the financial markets, but at the same time will have a huge impact on the financial markets if somebody does start firing shots across the borders. You'd like to think that they're going to talk it down, de-escalate the tensions. And it's been building for a long time. Russia's been amassing troops on the Ukrainian border for months and months, and it's largely been ignored. But it's getting quite serious now. NATO is talking about mobilizing troops. The states are talking about mobilizing troops. There's talk about ships and planes and all sorts of hardware getting to the area in the Ukraine to try and help them defend themselves. So I'm not a political analyst. I don't know the actual ins and outs of it, but I do know that if it does get out of control, then we're going to feel some pain. Because of that, the dollar attracts safe haven status, or improves as a safe haven asset, and it sees buying while the euro is getting sold, and so the rand by default loses ground against the dollar as a result. The main event, however, is central bank activity, and we've got 2 days, one today, one tomorrow, big announcements that the rand needs to keep an eye on. Today, the Federal Reserve, the American Central Bank, they're going to be later tonight, 8 o'clock tonight, releasing their latest monetary policy announcement. The market has got so worked up about how quickly the Fed is going to have to act to try and tame US inflation, which is sitting at a 40-year high at 7%, that it's pricing in all sorts of crazy interest rate hikes. We used to think maybe 1 hike in 2022. Now Goldman Sachs is saying 6, maybe 7 hikes, talking about trimming their balance sheet, selling bonds back into the market, all sorts of things that are spooking the market, causing this equity sell-off. We started the show talking about how the market is taking a hiding. It's 100% down to what the Fed might do, not what they're going to do with them. That's at 8 o'clock tonight. I like to think that Jerome Powell, who's the head of the Federal Reserve, has a cool head on his shoulders. He likes to try and do a balancing act and, signal intent, but not try and outstrip or meet market expectations. personally, I think the dollar might come off later tonight, but that's just my opinion. Please don't trade it
Yeah.
on that. But I think there's room for him to disappoint the market.
Yeah.
Tomorrow, straight afterwards, we've got the Reserve Bank, our own Reserve Bank, talking about our own monetary policy.
Yeah. And are there any expectations from tomorrow? I mean, one thing that's great is that we get to do ours after the US do theirs. Are there any expectations that the market have priced in or are concerned about? Or
Yeah, absolutely. You know, we can see with the rand on a strengthening trend during a period where the dollar's actually gaining itself, we've got the market pricing in rate hikes for both. So we're looking at higher interest rates later in the year, not tomorrow, tonight. The Fed won't hike rates tonight. They're talking about potentially starting in March. But because of March and then maybe June and then later in the year, the dollar's been on the front foot. The same goes for the rand. The Reserve Bank hiked interest rates for the first time in 3 years in November last year. This is their very next meeting, and by all expectations, they're going to go again. Lesetja Kandiago, the governor of the Reserve Bank, has said that the Reserve Bank is ready to meet the Fed and to go with the Fed. If they're going to tighten, we're going to tighten. Remember, the Reserve Bank mandate is to tame inflation, as is most Reserve Banks. We're sitting at 5.9% CPI, consumer inflation.
In the US?
No, in South Africa.
Oh, in South Africa, okay.
7% in the States. The States, it's runaway inflation. In SA, we're sitting at 5.9%. The Reserve Bank's target range is between 3% as a low and 6% as a high. We're right on that 6% high. And obviously, the worst for the rand, if the rand blows out because of dollar strength, that means our imports get more expensive. That means inflation goes up. So yeah. I fully expect a cut tomorrow. I mean, a hike tomorrow by the Reserve Bank, and the market is expecting the same thing, which is why the rand is on the front foot. So you're right.
Yeah.
We get to pull the trigger after the Fed, although I would have thought maybe that decision's been made already, but we can be reactive.
Yeah. So, hey, it's just a quick one. I did miss you. What is the CPI for the US market at the moment? I didn't quite get that.
7% consumer inflation.
7%.
7%.
Okay.
Their target is 2%. All right. And
yeah,
they have
wow,
to hit 2%. Since 2008, the global financial crisis, the Fed's mandate has been trying to get inflation up to 2%. They've been hovering between 1 and 1.5% for over a decade. There are various factors have contributed, the supply chain bottlenecks. It's all COVID related, but inflation is now off the charts, 40-year high. So the Fed's going to have to do something.
Yeah. I remember our early talks last year, you spoke around the Fed saying that the inflation rate was really just because of COVID, and it was transitory rather than something that is going to be there for a long time. Are they still in the transitory kind of mindset, or are they looking at higher interest rates over a protracted period of time?
Yeah. Transitory has officially been put to bed. Jerome Powell, in their meetings towards the back end of last year, said that as delicately as he could, he said they were going to retire the term. Basically means they got it wrong. It's not transitory. It's more sticky. Will come down. It's not like inflation, at least we don't think so. Like it's just going to run away from 7 to 8 to 9 and 10%. It's all about logistical issues and supply issues. So a lot of ships just can't get containers and can't get into ports because there's reduced activity in ports because of COVID reactions. Like in China, one person got tested positive in their third biggest port. They shut the whole port down. Now nothing can move in and out of that port. So if you're waiting for goods that are now can't leave China, whoever's got those goods can sell them to you at a higher price. That's an inflationary.
Yeah.
Also, think about the factories out there. All the factories that are supposed to be pumping out goods also get closed down because of positive tests, and that limits the supply. That all feeds into the inflation story. So the Fed is saying that, the world is going to get back to normal activity. And I think we're seeing that, especially here in SA. Our COVID numbers went ridiculous over November, December with the advent of Omicron. Come right down very quickly. And as we know, the medical impact hasn't been as severe. And we hope that's going to be the same story around the world. Businesses will get back to business as usual. Supply chains will unblock and inflation will come down. But in the meantime, it has to start hiking interest rates, because if they don't, they're going to be seen to be doing nothing and potentially the cause of a recession.
Mm. Just a quick curveball I wanted to throw at you. You're speaking about China. China's policy was to cut interest rates whilst being faced with global inflation problems, just like every other country.
Yeah.
Why would they have done that? It's almost completely the contrary to what the US are doing.
Yeah. So China's got a policy of zero COVID. They don't want to have any cases because they've got 1.6 million people plus. Their vaccine, the Chinese vaccine, has been proven to be ineffective against Omicron, and they're reluctant to buy vaccines from anywhere else. So they're kind of cutting their nose off to spite their face on that score. Even though Omicron doesn't result in a huge amount of hospitalizations and ICUs and deaths, not like Delta did and previous strains before it, if you just run the numbers and put the number of people that would get infected in China through Omicron's extremely contagious characteristics, they're still going to have hundreds of thousands of people needing to go to ICU. Okay, so they have got the zero COVID policy. They are curbing economic activity by shutting factories down, shutting whole cities down if there's an outbreak of COVID. Because of that, the economic performance, their GDP growth rate is slowing. And China prides itself on an elevated GDP number. So they are cutting interest rates to promote economic activity where they can to try and prop up their GDP growth.
Okay.
Their interest rate cuts, while we see the headline, China cuts interest rates, it's not the same as what we do. They're doing a 10 basis point cut. So it's like almost nothing on a specific loan, and another 10 basis point cut the next week on a different loan. So it's not like the interest rate across the board that you'd expect when you read the headline.
No, that's fantastic. Hayden, thank you so much for the insights. And I hope you have a fantastic week. And I hope the phone starts ringing for people to take money and get the opportunity to invest rather than to phone you to find out what's happening in the world like what we've just done today. But I hope you have a very successful week this week. And I look forward to seeing you again next week, Wednesday.
Thanks, Gary. And just as a parting note, we are using this opportunity as a buying opportunity. We do have fresh cash on the sidelines that we've been keeping as cash for something just like this. It's not too late if people want to add to their portfolios. It's not like we're going to bounce back 15% overnight. These buying opportunities don't come around very often. We should be making use of it. But it does come with the little caveat that when you look at your portfolio, it's not going to look like what it looked at the end of December. But that's all part of the parcel of the process.
No, that's fantastic. Hayden, thank you so much. And we'll chat to you soon.
Great. Thanks, Gary. Chat next week.
Cheers, Hayden.
Bye.